and let's try to understand what exactly is a future and why these futures and options, both of them are regarded as, see, both futures as well as options, both of them are, these are actually meant to be, these are called as derivatives. Both of them are called derivatives. Now, what do you mean by derivatives? Derivatives means they don't have their own value. They derive value out of an underlying asset. So underlying asset is going to be different for different things. For example, an underlying asset for a Nifty index is going to be whatever you are seeing as Nifty spot. Whatever you are seeing in Nifty index is going to be a reflection of what happened to the Nifty spot price, whatever you see, right? Similar to that, whatever happens to any specific stock, for example, the HDFC, Reliance, or whatever stock you want to take. So whatever happens to the stock, it could be the spot price or stock price. If I am talking about specifically, if I am talking about equity market, it is going to be spot price or stock price. But the same thing is also available in a commodity market. It is also available in a currency market. So it's available everywhere. And the whole thing works very similar in all the segments. So what happens is, it is the underlying asset which is important. It is not the future. Future is going to derive its price from the underlying asset. So if you have to talk about, for example, crude oil. In crude oil, what happened is, there could be sometimes temporarily futures may actually react adversely. Futures can react adversely. Like, for example, crude oil had come down almost up to $20 per barrel, right? And from there, actually, it started moving up. But the spot price, or if you look at the overall, never have we got at that price when we have actually been buying any petrol or diesel or any of those things. We have not been buying. What it is trying to reflect is that that point of time, there was huge negativity in the market, and that broke the prices down. And these people, when they saw that the supply is creating a problem, they started actually reducing the production itself. So what has happened is, if you look at the overall demand has not increased. What has happened is, supply has been cut down, the production has been cut down. So because of that, oil prices have moved higher, and that is the reason what you are seeing, the reflection of whatever it was happening there. Now in the future, what is happening is, the production is getting increased. Slowly they are starting to increase the production. So what is happening in the live market is going to reflect there. So similar to that, it could be gold prices. Whatever happens, if gold prices is actually given at a discounted price than what is available, what is seen in the what do you say, in the market price, whatever you are seeing, right, on the futures and all, whatever you are seeing every day, they talk about whatever is mentioned there, no?
Bullion market.
They are giving you discount on that. That means they are trying to, that is what is happening in the real market. So if that is happening, then the things are actually changing there. So that is the things which are happening in the real world. The real world is nothing but your spot price there. In commodities, it is a little difficult, because Every state has a different price. So it's not actually uniform one single price which is there. Every place actually the things are little different. Overall, actually the prices vary based on the central tax as well as the state tax and all. There is a little change, but overall what happens is the futures and options both are derivatives, and both of them, the value is getting derived out of what happens in the real world market or the underlying asset. Are we clear? So underlying asset is deciding what is going to happen in the future market or in the option market. It is not the other way around. So what actually this?
So do you mean this is dynamic? Is it dynamic you mean to say?
See, everything is dynamic in the market, right?
Market, huh? Right.
Every second there is buying and selling happening.
Right.
So what happens is whatever happens in the spot price or the stock price, that is going to reflect in the future price.
Okay.
Are we clear on this? See, this is the very first basic part which you need to understand when it comes to futures and options.
So that means every share has its own futures and options, is it?
Not necessary every share. In fact, in US, actually every share may have. But in India, what happens is based on the volume of transaction happening, the exchange decides which stocks will have the futures and options. Not
Perfect. Got
every
it.
stock will have the futures and options. There are specific stocks which have huge volume of buying and selling. For them, they have actually the futures and options. For others, they are not having it.
Got it. Got it. Thank you.
Okay. Now, what actually, why this derivative is there and what is the use of it? How the investors use this? Let me make you understand this. See, derivatives are majorly contracts. If I buy a stock, for example, I buy a Infosys or a Reliance or any stock, whichever you want, you can keep it for your lifetime. You can actually pass on to generations together. As long as the company is there, you can actually hold the stock. There is no problem. Or the company has to delist themselves. Now, what is delisting? See, there is something called enlisting or actually listing the company, which is your IPO, initial public offering. Like recently, LIC came into the public market, right? Now, at the same time, a company wants to go back private. They don't want to actually be in the public domain. What they could do is they can delist themselves. Delisting, what happens is they have to go and pay a price. They have to go and pay a price to all the shareholders, whatever is agreed upon. For example, there could be a market, the price could be trading in a particular range, maybe 100 to 150. It has been trading for maybe a couple of months or couple of years. So it would actually decide on a particular price and go and put this statement or this it will actually publicize this, and it will also seek permission of all the shareholders for this. If all the shareholders, majority of the shareholders agree on that, then they will be able to get at that particular price and they can exit. So at that point of time, it gets delisted. It will not get listed. It will be getting delisted from that. Okay. So recently Vedanta wanted to delist themselves, but majority of the shareholders rejected that offer. So it was not able to delist. Generally, delisting process is a lengthy process. After it is actually being talked about in the market, it has to give a notice in the SEBI and all, and SEBI has to approve it. After approving, it takes roughly around 1.5 years or 2 years for them to get delisted, so that everybody gets an opportunity to exit at a good possible price. So here the company will be buying back the shares and actually getting out of the market. I hope you are able to understand this. Now, in this case, derivatives, what exactly happened? Why would someone want to delist? See, they want to become back a private limited company. They don't want to keep everything in the public domain. So in that case, they want to delist.
Oh, it's beneficial for them, is it? Obviously, it must be.
See, generally what happens is a private limited company becomes a public limited company. But sometimes actually they may actually not want funding they have sufficient, and they may not want really to expose everything in the public domain. So it is personally the company's choice anyway. So generally delisting does not happen most of the time because the fluctuations are too high. It could be probably some or the other negative factors which are affecting. They don't want unnecessarily the price of the stock to come down a lot and all. They may do that. It is up to the company what they want to do, and if they feel that they are getting better valuations in the private limited, they may want to do that. It is completely the company's decision, but shareholders needs to approve. Yes, sir.
Well, my question is, yes, my question is that decision has been taken by company in the majority of the, with the acceptance of majority of the shareholders. But if some shareholders are not willing to get
That's
this,
what it has to be majority, right?
yeah. In that case, the person who doesn't want to company get delisted, he has to mandatorily surrender his shares at the prices company are giving to them.
If majority of them are have actually approved it, then there is no choice. Otherwise, what happens is he may have the shares which will have no liquidity because there is nobody to buy.
Yeah.
Within that period, they have to get out. Otherwise, actually, that will be worthless.
Okay. Yeah, if it's delisted, then there is no trading on that share. So
Correct.
where to sell it? So they have to sell it anyhow.
Correct.
They want or not. Okay.
Correct.
Thank you. Thank you.
Okay. So let's try to understand what exactly happens. So derivatives are basically contracts. So as I said, a company, if you have bought a stock or if you buy gold, you can hold it forever. Nobody will actually ask you to actually give it back, right? But if you are buying a contract of gold, see, even if you are buying something like a ETF, exchange traded fund, that is very similar to your mutual fund. That you can hold forever. There is no problem. Now, the main challenge is these contracts. Now, these contracts always have something called as a validity. They also call this as a expiry date. Now, expiry date is the date on which this contract is going to become null and void. This expiry is a date where the contract has no value of its own. Now, on the day of expiry, it is very important for you to exit this. There's no choice. So derivatives always come with a expiry date. So that means they are valid only for that particular period of time only. So if suppose you wanted to buy a particular stock and you want to keep it only for a period of 1 month or 2 months. See, maximum here in India, they give you for 3 months. 3 months is the maximum period they are ready to give you. So you can actually buy and hold this. In case of commodities, they are giving you a little higher amount of period. But in case of stock market, they're giving you a maximum of 3 months. Contracts are available for you if you want to buy and hold.
Okay.
Now,
sorry.
yes.
If we have chosen for 3 months or 2 months, whatever the time limit is, if you want to come out before that, we can, or there's a minimum
You
time
can do
also.
it even for a intraday. That means you can buy and sell in the same day also.
Okay.
There's no compulsion that you have to actually hold it for 3 months, but you have a choice to hold it for 3 months.
Okay.
I hope you are able to understand all this. Now, what happens is futures is very similar to buying a real stock. It's very similar. I'll tell you the difference. Number one difference is the expiry date. Okay. The second difference is you cannot buy only one stock. For example, one stock, if I want to buy one Reliance share, I can buy. But here you need to buy at least one lot. Like for example, if you are taking anything in an IPO, they actually give you in a lot size. That means they have a predefined fixed amount of shares which you are supposed to buy. So you have to buy that much. You cannot actually reduce this. So the lot size is going to vary from contract to contract. It's not going to be fixed. It's going to change. Okay. Contracts are going to be different. And so for each and every contract, each and every stock, this is different, and this is decided not by you and me, it is decided by the exchange. And it is actually going to be based on that, what exactly, why people are buying here is because futures are going to be available at a discounted price. That means you don't have to pay the amount of money. I'll just give you an example. Suppose you want to suppose you want to buy a Reliance share. Now, Reliance share, I don't remember the exact lot size. Currently, it is somewhere around 2,500, 2,600, somewhere in that range it is there. Okay. Now, suppose the lot size, I'm just taking an example that the lot size is 100. I don't know, I don't remember exactly is this the lot size. That means if I have to buy 100 shares of Reliance, how much it is going to cost me? Around 2.5 lakh rupees.
Yeah.
Right. Now what happens is when you are buying a contract, you may not have to pay 2.5 lakh rupees. Actually, the lot size is way bigger, I think. Roughly, this is the amount you will have to pay as a margin amount. But what happens here is, I think it is a little higher than that, but it will be discounted. It varies based on the volatility of the price as well as how much actually the movement is happening. Based on that, you may actually pay up somewhere between 30 to 60%, or probably plus or minus here and there, based on the total amount. Suppose for this example, if I'm supposed to pay around 30%, I may actually end up paying somewhere around 75,000-80,000 rupees. But actual margin, I think, is more than that. I'll actually show you the actual margin and explain you. Let me actually do that one. Okay, let's actually go to the margin calculator. Okay. So let's take the example which I was talking to you about. Don't know why it is not. Okay, let me take input. Okay, look at this. Let's take a May month contract. Look at this. It is showing you the expiry is what? till 26 this is contract is going to be valid. The price which you are supposed to pay is this 1426, that is a future price currently, and the quantity is around 300. So let's try to calculate this, how much it is going to be, how much it's going to be, roughly around 1500. 1500 means 4.5 lakh rupees approximately. I'm just giving you a rough figure. Okay, roughly around 4.5 lakh rupees, correct? 4 to 4.5 lakh rupees is what you were actually supposed to pay. But since you are actually taking this via future, sorry, can you please mute yourself, whoever is speaking? Okay, look at this. What is the margin required? I just have to pay around 79,000 rupees, and I am getting shares worth how much? I'm getting shares worth 4 lakh plus. Are you able to understand this, guys?
Yes, very much. But where is that 79 rupees reflecting?
Here, look at this.
It's called margin required. So you can buy these.
Okay, margin
stocks at
required.
that
Oh,
price.
okay, margin required. Got it.
Okay, so what
Yeah.
happens is you're not paying the entire amount. What you are paying is the margin which is required. So this is again decided by the exchange, and it will change every day, because this price is going to change every day. This is not going to change. It is going to remain fixed until unless they are going to change anything. But this is going to change, because this is going to change. This will also change, because this is a percentage of the total amount whatever you are supposed to pay. I hope you are able to understand this.
Yes.
Okay, fine. Now that you have understood this, let's come back. So what happens is you are getting at a discounted price. So why are people buying? Because they are getting at a discounted price. Now, second thing, what happens is whenever you are buying a future contract, you also need to do a couple of things. That means, see, if you have bought, then what happens is when price increase, you are making profits.
In this case, only till the 26th.
Yeah, you can take next month contract.
Acha, okay.
See, currently we have only 6 days. You can take next month contract or next to next month's contract. 3 months you can take. So you can take, right now we are in May, June, July, August, you can take.
Okay.
So if you have bought, if your price decreases, then you are in a loss. When I'm saying loss, this is a notional loss. It's not necessarily a loss until you have actually exited from the trade. But still there is a notional loss which is going to be there on the system. And they are giving you at a margin price. So what they want is whatever, if there is profit, they will not ask you anything. But if there is a loss, then they want you to add extra margin, whichever is your total loss. So you can here buy a contract, you can also sell a contract. Now you may ask, how can you sell when you don't have? See, what happens here is, in stock market, there is a concept called as short sell. Short sell is something where you don't have anything, but still you will going to sell. What you are doing is you are borrowing from your broker and you are trying to sell this. And when you sell this, see, instead of buying and selling, you are selling and buying. When you will do it, when the market is coming down. When the prices are coming down, what you do is you sell and then you buy. Are you able to understand this, guys?
Yes, yes.
Okay. So you are going to sell and then buy. So what happens is you can do any of these things. Now, what happens in a future contract? Futures and options can be cash settled or stock settled. Now, what do you mean by that? It means that I can either do one thing. I can buy the stock, sell the stock, and later when the price comes down, I can buy it back in the real stock. See, I had paid a margin of around 80,000 rupees. But when the price comes down, I may go ahead and make that additional amount, which was around 4.5 lakh rupees was there, but the price may come down. So instead of 4.5 lakh rupees, I may end up paying maybe around 2.5 lakh or 3 lakh or whatever is the price. I don't know. So what I can do is I can go ahead and buy this stock and settle this particular contract.
In that case, we have to take the delivery. We have to hold the delivery, right?
Yes.
Okay.
So you can actually do something called as, you can stock settle the stocks.
Okay. So we will have both the options. Either we can square up the trading, or we can hold paying the margin or difference, and we can hold it.
Correct.
Okay.
In case of futures and in case of options, actually, that is the reason they want you to last week expiry. No, they don't actually want to. They don't allow you to buy the options because they want you to cash settle this. If you see there, they actually want you to buy a next week. If you already have, you just try to settle it. So what happens is, let me actually give you some examples here. If suppose the Infosys share was 1,400 and you bought this and it actually went to 1,500, giving you an example. So how much you made a profit? It is 100 points of profit. 100 points multiplied by the lot size. Lot size here is 300. So that means you made a profit of how much? 30,000 rupees. Are you getting it?
Yep.
So this was the future price when you bought. This was the future price when you bought, when you paid that margin of around 80,000 rupees. And when it increased, it has actually made you this profit. Now you want to exit, you can exit and you will get this extra funds in your account. Okay. If you don't want to exit, you continue to hold. So whatever happens to the price, this is going to reflect. Instead of that, if suppose it came down to 1,300, so what happened is, instead of profit, you have 30,000 loss in your account. So this is the extra margin which you need to add on to your account. So if your account doesn't have sufficient funds, then the broker has all the rights to exit your position. Without your actually intervention, they can exit your positions because they don't want to come under loss. See, what happens is, if you are under loss, now SEBI is actually monitoring everything and they want you to, if you are not paying, then they are actually going to end up in a penalty and all. So they want you to actually ensure that that margin is available in your account. If amount is not there in your account, or if the loss increases, see what happens here. The problem is, if things go completely against you, suppose instead of 100 points, it moves against you by say 300 points. So it comes to 1100. So what happens? Your loss will go to 90,000 rupees.
Yeah.
You paid a margin of around 80,000 rupees. 90,000 loss actually broker will not take. Who will actually pay this? Right? So what happens is most of the brokers will give you a warning when there is 50% loss. They will give you a warning. And when it exceeds to maybe, it depends on broker to broker, it could be 60, 70, 80, whatever is the loss is there, they will compulsorily exit. Whether you exit or not, they are going to exit your trade. Are you getting the point, guys?
Yeah.
So
Yes,
this
sir.
is,
So,
yeah,
Yes, sir.
Sir.
Is there anything like stop loss or something like what we do in stocks here?
see, everywhere you can put the stop loss. See, stop loss will work only when it's a live market.
Okay.
Market
Right.
is live, it will work. There are something called GTT orders which you can put, which is called good till triggered. But what happens is overnight positions, what will you do? See, if you have bought something, all of a sudden, next day, it opens a gap down, that price will never come, no, whatever your stop loss was there.
Yeah, that is the thing, sir. Correct. Yeah.
So there it will not trigger only.
Yeah.
It cannot trigger. See, if
Yeah.
there is a gap which will happen, no, that price, if whatever price you have given that doesn't come, that will not get triggered.
Okay. Suppose if I have purchased at 100 and put 90 as a stop loss, suddenly if it goes to 70, then that won't get triggered.
That won't trigger.
Okay. All of a
Because
sudden it
that
has
price
gone.
never came. No, you have put at 90, that price itself has not come.
Okay. Suddenly it has gone into 70, so it cannot sense it.
No, see, it works on if and if this price come, then exit. But if that
Oh,
price itself doesn't come, where will it exit?
okay. It has gone beyond that.
Yes,
Okay.
yes.
Okay. So got it, sir. Thank you.
Okay. I hope you are able to understand all these concepts, guys.
Sir,
Is there any confusion?
Yes.
sir, one question.
Hmm.
You mentioned that there will be a notional loss, right? For example, I buy a lot of 100 today, and which is having an expiry of 1 month.
Hmm.
After 3 or 4 days, there will be a notional loss of uh, around 10,000 rupees.
Hmm.
So, what is the action from my side? I mean, in the sense,
See, as long as that money is there in your account, there is no action required.
okay. So
If
it
there
is
is,
not that I'm going to observe it every day. Uh,
see,
okay,
it depends
I have
on
to observe
what
it
you have
every day and
done.
keep the appropriate amount in the account. Is it?
See, generally what happens is
Hmm.
it won't actually go up or down too much until unless market is volatile. Currently, what happens is market is too much volatile.
Correct.
So because market is too much volatile, anything can happen. The monitoring is more required if you are trading. If you are
Okay.
an investor, you should rather take a bigger contract for a higher duration, where
Mhm.
you feel that yes, this stock is good at this price, even if it is coming down, I'll rather go ahead and buy that particular share.
Okay.
If it is coming down, instead of actually taking that loss, what you could always do is you can buy the stock and hold it forever.
Okay. It's like you are purchasing the full lot completely, not on the
Correct,
amount.
correct.
Okay. Got it, sir.
So what happens is a lot of retail investors, retail traders, they use this for trading purpose. And most of the institutional investors use this mainly from the point of view of buying the, see what happens is we buy and sell, right? But what actually all these institutional investors do, they always sell first and then they buy it later. So what happens is they will sell in the initial days, and then they will actually go and purchase this back at the later on stage. They are going to rather stock settle. So what happens if they want to buy a particular share, they will first sell that share in futures, so the price will come down. And because they are not selling in small quantities, they are selling in big quantities. When they sell in the futures, they will also sell in the options, in the real market. But the problem in the real market is, if you sell something today, actually there's no option to hold on. Earlier, the settlement day was T plus 2 days. That means transaction day plus 2 days were given. So totally you had 3 days before which that share had to be in your account. But now what has happened, it is T plus 1 day. So what happens is, if you do the transaction today, the next day itself, it has to be in your account. So in that case, what happens is, I cannot sell something and continue to hold. If the market is falling, I cannot actually use this in the real stocks. So what I'll have to do is, I have to do with a contract like this, futures or options. I have to use these contracts to do any kind of these transactions. Are you able to understand, guys? So what happens is, they are going to go and sell a contract and they are going to buy it back later. They can either buy the contract or they will go and buy the real stock. So it depends whether they are still expecting the market to come down. They may actually continue to hold this contract. They may actually sell this month's contract. They may actually buy this contract and sell the other contract, or whatever is their expectations. So what happens is, generally all our institutional investors always do this. They sell first and then buy next. Are we clear on till now whatever I have explained you about futures?
Yes, sir. So the expiry and the lot will be decided by the exchange. We cannot decide that.
Correct. Expiry is decided by the exchange. Lot size is decided by the exchange. Price is decided as and when the demand and supply, as it happens in the market.
It changes every day. Yeah, depending on market.
Yeah, every second it changes. No.
Thank you.
Sir, one thing is like here, for example, a company has 1 crore of crore number of shares, right? So, and each share is actually owned by one person, right? At any moment of time, right? How exchanges generate these lots? I mean, like they have to generate, and if a person want to buy it at the end, like completely own it, then from where these lots will come?
I didn't get you.
See, for example, 1 crore number of shares are there. At one point in time, it is always owned by one or the other person, and
Correct.
these lots are actually generated by the exchanges. Per se, if they have set 1,000 as a lot, 1,000 stock as a lot, and we start.
See, what happens is, lot size is decided by the exchange, but what happens is, everything is based on demand and supply. See, for every buyer there has to be a seller. So there is a buyer, there is a seller. There is always a demand and supply. So it is only about agreeing on the price.
Yeah.
Only when both of you agree on a price, then the transaction get executed. So there is a buyer, there is a seller. They are actually exchanging this. So end of the day, end of the month, they have to actually exit at whatever it is. Otherwise, it will anyway get exited. Because it's anyway a contract. It has no validity after that.
Okay. So even the seller also will be ready to sell it off at the end of the month.
He has to sell. No, there is no choice.
Yeah, buyer has to be ready to buy it by end of the month.
Which one? No, see, seller has to buy, buyer has to sell.
Okay.
See, if you are
and we don't have to physically sell it. If the money is there in the account, then automatically the transaction happens, right?
Yeah, end of the day, end of the month, it will happen.
Month,
if you're
हाँ.
not buying.
Mhm.
So if you only exit, no, whenever you have made profit, you can always exit. You don't have to keep it till the end of the month and all, right? You can exit any point of time.
So just another question in the whole lot, what is the percentage of people investing in futures and options versus investing in the market shares?
See, investors are actually directly investing in stocks, but
Stocks,
they actually use this more as a hedging tool, or when they want to bring the price down, when they expect the prices to come down, they may actually go and do this, or they will want to use this as a hedging tool. So hedging tool in the sense, when you have a lot of shares and you don't want actually, if see, it is like this, hedging is where you have transaction in both the places. So you could have a stock which is a real stock, and you could have a future which is in the sell mode. So this means if stock is increasing in the price, you are benefited. But if this is coming down, price comes down, you will make some profits here. So this is not from the point of view of a trading purpose. This is from the point of view of hedging your portfolio. That means if something happens and the price comes down, I don't want to get affected. From that point of view, they are going to hedge this. At a higher price, when you expect that prices actually may get into profit booking mode, or prices may come down, you can actually go and hedge your stocks. If things are uncertain, you can hedge the stocks. So futures, you can use this. You can also use options. I'm just giving you an example. You can do that. Getting the point? But if you have sufficient thing, then you can do it. If there is not much of a thing, you can use options, because that will be much more cheaper compared to futures. Are you getting this?
So when do we invest in futures and when do we invest in options? If a little clarity can
See,
be.
options, when we talk about options, we will talk. Currently, futures.
Okay, we haven't spoken about options, right? Okay, done.
No,
Done. Got it.
options is a
Got it.
very, very vast subject, and it will take a lot of time for you to understand what is options and all. So currently, we are only talking about futures.
Got it.
Are we clear? Is the question answered?
Yes, sir.
Whatever you asked, was it clear?
Yes, it's clear,
Yes.
clear. Thank you so much.
Okay.
Thank you so much, sir.
So I think it's already 8 o'clock. I'll just take quick Q&A for your question, sir. Brahmam sir, you asked, no, why, how can we stay invested?
Yes,
The
sir. Yes, sir.
first and
Yes.
foremost thing, you will stay invested only when you have the conviction in that stock. If you don't have the conviction in the stock, no matter what, you will not stay. So first and foremost thing, the fundamentals of the company has to be good. If the fundamentals are not good, there is no point in actually staying invested. See, currently you were actually talking about HDFC Bank, right? See, HDFC Bank, if you talk about HDFC Bank, it is one of the largest private sector bank, and it is one stock which has the highest market share. Okay, let me show you. So if you just search highest market share, market cap, so you will see this. Look at this. HDFC Bank is the third largest. Number one is Reliance. Number two is TCS. Number three is HDFC Bank. So the market cap is extremely high, very big. Number one. Number two, this is a company which has been able to give consistent result. If you look at banking as a sector has a lot of challenges especially with a lot of people not able to repay the loans, and also what happens, a lot of the debt get into a non-performing asset. But this is one company which, if you look at the results, has been very, very consistent. And this is the reason why a lot of investors are ready to pay a higher price to buy this bank. But every company will always see, it doesn't matter which company it is, if it has gone up a lot, it will also correct. So correction is always good, and that has to be used for buying this kind of a stock. If the company is good, if you are getting at a very good valuation, that is the time you have to go ahead and invest. This company, if you are, see, it may actually be down. Will it be down for a longer time? I don't think so. If it is longer time, if it is down, that means a lot of people are buying and accumulating. Once actually it starts moving up, you will actually see a huge up move in that particular price. Currently, all the IT stocks are down. Now, see, the problem here is when stocks goes higher, people feel it is very expensive. When they come down, they feel actually, array, it is down. What should I do? See, we are reacting in the opposite thing. When the thing has come out cheap and it is a good stock. See, you should know it is a good stock. It is a good company. It is actually giving consistent result. It has good money in the books of account. It is having all the businesses where they are doing. You should know in and about the particular company. If you know about the company, see, this may be down. It will not be down forever. Like, for example, if gold comes down now, will you go and sell? Will you not stay there? So when you are buying, buy with the intention of staying at least for minimum of 3 to 5 years. There's no way you should actually, if you have stayed invested in these kind of companies at this prices, you should minimum be able to make around 10 to 15% year on year. These are actually not a company where you will make 100%, 200%, 500%. It is possible, but it's not practical, because these are already a very big company. This is company which you have to look more from the stability for your portfolio, because these are going to actually strengthen your portfolio, because when they come down, they may not come down too much, but when they go up, they will go up a lot. Are we clear?
Yes, sir.
Yes, sir.
So your problem with staying invested is because you are entering at a wrong price. See, when at these prices, go and enter, then your prices are very cheap. But the problem is when it goes up, then only we want to enter. That is where we actually have a problem. When it has already gone up, then actually it suddenly comes down a little bit, we get afraid. Getting the point?
Yes, sir.
Sir, to get the conviction, we need to check out some parameters. So
we have
how
talked
to-
about this multiple times, sir. But if you want, we will talk sometime later. But right now, it is not possible to address in 5-10 minutes.
Okay, sir. Okay, sir.
Yeah. Any other questions you people have? If there's no question, I'll wind off the session. If there's
One
any
last question. I think you said in the futures, when it's coming down, if margin notional loss is about 30%, 40%, the our broker will give the warning or something. You said it if you do not have balance, how do they settle down? Suppose there is no
so
margin.
they are going to wind off the position. They are not going to wait till you get into a loss.
Oh, okay. So they give
They will cut the positions. That is actually automated, that they have something called as RMS, which is risk management system, where they actually, if it is exceeding a particular limit,
margin.
whatever they have
Okay.
said, if it is exceeding, they will automatically square off your position, no matter what. They are not going, there's no discussion on that.
Oh, okay. These automated systems.
Yeah,
Okay.
that's why they keep the margin. Okay.
Okay, got it.
Clear?
Thank you. Thank you very much.
Oh,
So it's a safer bet any which ways.
No, ma'am, it is very, very,
No? Very volatile.
No, it's, see,
Very
everything is volatile in stock market. But if
Risky,
you
risky.
don't understand this, you will make
Ah.
big losses here. You have to be
Okay.
very careful when it comes to futures and options, because see, in case of stocks, no, you can keep it forever.
Hmm.
But here there is a time limit.
Yeah,
As
so
long
if
as
it's
you-
a loss, it's a major loss then.
See, if it is a major loss, it is
Can be
going
a
to wipe
major
out
gain
your
also sometimes.
Again, also sometimes
So
exactly.
both
Again
way,
also.
major
Both way,
gain and major
yes.
loss.
Major
Yeah.
gain.
Yeah.
See, you first decide whether you want to become a trader or investor. If you want to be an investor, directly invest in stocks.
Stocks, right.
There you have no time limit. No, you can
Hmm.
keep it forever. So even
Right.
if it comes down, you have nothing to worry. If it comes down, you can actually add more positions also. You cannot do that everywhere. If it is in a company which you want to stay invested. See, the companies like these big companies, they will not actually, it doesn't matter whether there is a COVID crash or any other thing. See, there will be a lot of reasons why prices will come down. It doesn't matter. But those are always an opportunity only for buying these stocks, because over a period of time, they have only kept on growing. So those are the companies where you have to invest, where the company is growing year on year, month on month, it is growing, and it is all, it has all the systems processes in place, and it is giving continuously profits. So if the company is delivering results which are profitable, then actually it makes sense to hold that company, right? If the company is making loss, there's no point in holding it. But if the company is consistently making profits, you can keep on holding it. There's nothing which will stop you from that. The price has to only increase, because the demand for that particular stock is going to only increase. Getting it?
Yes.
Okay, then. See you. We'll catch up next week then.
Okay,
Thank
Thank you very much.
Thank
Thank you very
Thank
much.
you.
Thank you.
Very clear.
Thank you.
Thank you.